Welcome back to the Deep Dive. Today we're doing something a little different. Usually when we talk about, high-tech transformations, these massive beats on earnings, companies just printing money, we're looking at Silicon Valley.
We're somewhere on the coast, yeah.
But today, we are looking at Hartford, Connecticut.
We're looking at the Stag.
The Stag.
Hartford.
The company founded in, 1810? And honestly, looking at this stack of research from their Q4 2025 earnings, which just dropped January 30th, this does not look like a 200-year-old insurance company.
No, it doesn't. It looks like a growth stock disguised as, a boring insurer.
It really does. And for anyone listening who thinks, okay, insurance, I could tune out now.
Oh, just don't.
Because this is a masterclass in how a legacy business reinvents itself. We are talking about a company that just delivered what was the number? 19.4% return on equity.
19.4%. I mean, that's the number that just jumps off the page. In the insurance world, that is elite status. You just don't see that.
Right. You see that in tech or high finance, not in a company that sells workers' comp. So the mission for this deep dive is to figure out how they did it. How do you take this dusty old insurer and turn it into an AI-first money machine?
It's a great question. And along the way, we're going to find some really strange signals about the broader economy. Yeah. Everything from the health of, plumbers and electricians to some very weird medical trends among high-income earners.
Okay, I definitely want to get to that medical data later because it is baffling. But first, we have to start with the beat. Because Wall Street analysts, they get paid a lot of money to predict this stuff, and they got this one completely wrong.
They missed the mark significantly.
So let's look at the scoreboard. Analysts expected earnings of, $3.22 per share?
Which, to be fair, would have been a perfectly respectable quarter. If they'd hit that, everyone would just nodded and said, good job, steady ship.
Right. But Hartford came in and dropped a core earnings number of $1.1 billion.
Which works out to $4.06 in share.
$4.06. So they beat the consensus by 84 cents.
I mean, that is a massive gap. In this industry, you usually see a beat of a nickel, maybe a dime. Beating by 84 cents, that tells you the analysts are just fundamentally misunderstanding the earnings power here.
And it wasn't just on the bottom line. Revenue was up to $7.34 billion, beating by over $50 million.
Yeah, beat on the top line, too.
Okay, but I have to play devil's advocate. We're looking at Q4 2025. It was a pretty mild winter, right? We didn't have a massive hurricane season late in the year. Is this just the Hartford getting lucky because the wind didn't blow?
That is the first question you should always ask. And yes, weather definitely helped, what they call psychics. Catastrophe losses, they came in under budget. If a hurricane hits Florida in October, these numbers look different.
Right.
But, and this is the key, you cannot credit a 19.4% return on equity just to good weather. It's not just luck.
So what is it then?
Well, if you strip out the weather, what you see is execution across three distinct engines. You have business insurance, which is their absolute powerhouse. You have personal insurance, home, and auto, which has made this serious comeback from the dead.
Okay.
And you have employee benefits. All three were firing at the same time. That almost never happens.
And when all the engines are firing, you end up with a lot of cash. I was looking at the capital management section, and it looks like they're just flooding their shareholders with money.
They are flush. In the fourth quarter alone, they bought back $400 million of their own stock. And for 2026, they're ratcheting that up to $450 million. Every single quarter.
That is just a huge vote of confidence. They're telling the market, we think our stock is cheap, and we know we have the cash flow to back it up.
Precisely. And the dividends flowing from their operating companies up to the parent company are expected to jump 16% to nearly $2.9 billion next year. That's not accounting magic. That's just cold, hard cash.
Okay, let's pop the hood. I want to see how this engine actually works. The biggest driver here, the golden goose, has to be small business insurance.
Small commercial. This is the crown jewel. If you want to understand why the Hartford is what it is, it's because of their dominance here.
The numbers are just wild. They hit an underlying combined ratio of 87.3. Now, for the listeners who don't spend their weekends reading actuarial tables, can we just pause on combined ratio?
Sure. It's the most important number in insurance. It combines your losses, the claims you pay out, and your expenses, your salaries, rent, everything. If that number is 100, you're breaking even.
$1 in, $1 out.
Exactly. So if their ratio is 87.3, it means for every dollar of premium they take in, they keep roughly 12.5 cents as pure underwriting profit.
And that's before they even invest the money.
Before they invest a penny. In the insurance world, getting below 90 is incredible. Hitting 87.3 is just exceptional.
And they're not just squeezing margins. They grew written premiums by 9%. So they're growing the pie and keeping a huge slice of it. But why? I mean, is their sales team just that good?
Sales is part of it, but it's really about the moat they've built with technology. You saw that note about the Keynova Group?
Yeah, I did. Ranked #1 for small business digital capabilities for the 7th year in a row.
And Keynova said they have a double-digit lead over their competitors. That gap is hard to close. See, small business insurance isn't like insuring a skyscraper. It's a volume game. It's a speed game.
Right. If I'm a local baker or plumber, I don't want to spend 3 weeks negotiating a policy. I want to fix pipes.
Exactly. You want it now, and the agent selling it to you wants it now. The Hartford treats small business insurance almost like a consumer product, like buying shoes online. They have this one Hartford approach.
So the agent can go in and just...
They can quote a standard policy, but then mix in specialty coverage. Let's say that Baker needs liability for a delivery van, and maybe cyber insurance because they take credit cards. In the old days, that's 3 different phone calls.
Huge pain.
The Hartford lets the agent bind it all in one digital experience.
That friction reduction is everything. You make the agent's life easier, they send you the business. It's the path of least resistance.
It really is.
There was also this quote from the CEO on the earnings call about their pricing power that I thought was really insightful. He was talking about raising rates, and he said, "You don't shock a small business customer."
That's a very specific philosophy, and it tells you a lot about how they see that relationship.
It makes so much sense, though. He said they take steady bites at the apple. So instead of waiting until inflation is killing them and then hitting that plumber with a 30% rate hike,
Yeah.
which just ruins their budget.
They do small, consistent increases. It's psychological. Consistency breeds retention. If you're predictable, the customer stays with you.
They aren't trying to gouge people. They're trying to be a partner.
Mm-hmm.
And in insurance, boring, reliable partners make the most money.
They absolutely do.
Speaking of boring versus exciting,
Mm-hmm.
let's pivot to the tech side, because this is where the narrative really shifts from old insurance company to something different.
To a tech company, almost.
Exactly. The CEO, Chris Swift, he made this pretty bold declaration. He said the heavy lifting of moving to the cloud and getting out of their data centers is largely complete.
Which is a huge milestone for a Fortune 500 company. I mean, getting off legacy mainframes is a nightmare. It takes twice as long, costs twice as much.
But he didn't stop there. He said they're moving to an AI-first agenda. Now, I have to be skeptical here. Everyone says AI right now. It's the buzzword. If you sell hot dogs, you're an AI-first hot dog stand. Was this real, or was it just fluff?
I was skeptical, too, until I read the details. They didn't just say, we use AI. They gave 3 specific use cases where generative AI is already deployed. This isn't theoretical, it's operational.
Okay, walk me through them. What are they actually doing?
First is claims. They're using Gen AI to summarize medical records.
Oh, that makes total sense.
Okay.
I can imagine the paperwork.
Think about the volume. A claims adjuster has a stack of PDFs, doctor's notes, hospital bills, MRI results. It takes hours to read and synthesize all that. AI can summarize that stack in seconds.
So the adjuster spends their time making a decision, using their brain, not reading paperwork.
Correct. Speeds up the claim, makes the customer happier, reduces the burden on staff. Second, they mention underwriting, using AI to get data-rich insights.
So knowing the customer better.
Yes. If AI can scan a business's entire web footprint reviews, website, everything, and tell the underwriter exactly what the risks are, you can price that policy with surgical precision.
And what was the third one?
The third one was multimodal customer interactions.
Which is a fancy way of saying better call centers.
Right, using Amazon's tech. But here's the so what on all this. In small business insurance, the margins are made in the pennies. If the Hartford can run their operations, say, 2 or 3 percentage points cheaper than a competitor because AI is doing the grunt work,
their pricing advantage becomes insurmountable. They can be cheaper and more profitable at the same time.
that is the holy grail.
Okay, let's look at the other part of the house. Personal insurance, home, and auto. A couple years ago, this was the problem child. Inflation just destroyed auto insurers.
It was ugly. Repair costs skyrocketed, used car prices, but they're calling 2025 a pivotal year. They have essentially fixed the car. Auto profitability is restored.
And they have this new platform called Prevail. Sounds very dramatic.
It is dramatic, but it's necessary. It's their new IT backbone. It's live in 10 states now, going to 30 by 2027. It allows for things like 6-month auto policies, better segmentation.
But here's the detail that I found fascinating, and I really want to dig into this. They're rolling out this fancy new system, but they are not moving their old customers onto it.
Right. They're letting the back book run off naturally.
Why? I mean, why not just migrate everyone and shut down the old system? Isn't maintaining two systems inefficient?
It creates some technical debt, sure, but strategically, it's brilliant. Think about the concept of a sleeping bear.
The sleeping bear.
Okay. You have a loyal customer, been with you for 10 years, they're on an old policy, the price is probably pretty good, they're happy. If you force migrate them to a new system, you trigger a re-underwriting event.
Ah, I see. The computer has to recalculate their risk score.
Exactly. And their price might change. Even if it goes down, they get a notification saying your policy has been updated. And what does that prompt them to do?
It prompts them to pay attention. And when you pay attention to your insurance, you go check if you can get it cheaper somewhere else.
Bingo! You just gave them a reason to shop. So the Hartford is saying, no, let the sleeping bears sleep. Let those profitable, loyal customers stay where they are. Use the fancy Prevail platform to attract new customers. It's incredibly disciplined.
That's such a subtle point, but it probably saves them millions in retention. Now, we've been pretty positive, but it wasn't all sunshine. We have to talk about the headwinds. There was a reserve charge, a pretty big one.
The dreaded A&E.
It's asbestos and environmental. I feel like we've been talking about asbestos for 40 years. Are we really still dealing with this in 2026?
We are, and we will be for a long time. They added $122 million for asbestos and $43 million for environmental cleanup.
I just don't get it. Why is this still hitting their balance sheet?
It's the long tail of insurance. This is the ghost of the past. Mesothelioma takes decades to develop, so they're seeing a higher frequency of claims now from exposure that happened 30, 40 years ago. But more importantly,
What's that?
they're seeing higher settlement values. It's getting more expensive to make these lawsuits go away.
Okay, and that ties into the broader pricing environment they talked about.
Yeah.
This is where we get into social inflation.
Which sounds like a made-up term, but I promise you it is very real to their bottom line.
So what is it?
It's the rising cost of claims from things like more litigation, bigger jury awards. Essentially, as a society, we're suing more, and juries are awarding bigger payouts.
So it's legal inflation.
Exactly. Even if the cost to fix a bumper is flat, the cost of the lawsuit after the accident is skyrocketing.
And that's why they said property prices are moderating, getting cheaper,
Yeah.
but casualty, the liability side, is staying expensive.
Exactly. That's why general liability and commercial auto rates are still going up. They have to keep their pricing slightly ahead of those loss trends, or that social inflation will eat their profits alive.
It's a never-ending race.
You're right.
Okay, let's switch gears to the last major segment, employee benefits. Group life insurance, disability, that sort of thing.
Another solid performer, a margin of 8.2%, which is very strong.
And there's some objectively good news here. Fewer people are dying. Mortality improved in their term life products.
Always good to hear.
But there was a weird data point that stood out to me. Short-term disability incidents are increasing, but not across the board. It was specifically among higher average wage earners.
That caught my ear too. Usually disability trends are broad or affect physical laborers. When you pinpoint higher wage earners, you have to wonder what's driving that.
Okay, so speculation time. Is this burnout? Is this the stress of the modern white-collar workplace?
It's very possible. We don't have the granular data, but we know mental health claims and stress-related leave have been on the rise. If you have people in tech, finance, management taking short-term disability, it suggests a workforce that's fraying a bit at the edges.
Almost like a white-collar recession of health.
That's a good way to put it. And disability isn't just a broken leg. It can mean severe anxiety, burnout, conditions that require a month or two off work.
And yet, despite that worrying trend, employers seem to love the Hartford. The sales pipeline for January 2026 is booming.
Known sales are up nearly 45 to 50% compared to the prior year. That's an incredibly bullish signal. It means companies are switching to the Hartford for their benefits packages in droves.
It just validates that bundle strategy again. You buy your workers' comp from them, your property insurance, and hey, why not throw in the group benefits too? It makes the relationship sticky.
Stickiness is the name of the game.
So bringing it all together, what's the big takeaway here? Why should you care about the Hartford's Q4 earnings?
The so what here is about discipline and adaptation. The Hartford is a legacy company that could have been a dinosaur. They could have been Blockbuster, but they successfully modernized. They aren't chasing growth in dangerous areas like direct-to-consumer auto. They are doubling down where they have a distinct advantage.
Playing to your strengths.
Exactly. And The move to an AI-first mindset in a boring industry like insurance, that is where the real efficiency gains of the late 2020s are going to come from. It's not about robots taking over, it's about robots reading medical charts so a human can make a decision faster.
That's a great takeaway. And I want to leave everyone with one final thought, kind of building on that asbestos charge we talked about.
Go for it.
We are sitting here in 2026 paying hundreds of millions of dollars for the industrial risks of the 20th century. We are paying for decisions made in the 1970s. But now we are rushing headlong into the AI age.
I see where you're going with this.
What are the long-tail liabilities we are creating today? What will the insurance companies of 2075 be reserving money for? Is it algorithmic bias lawsuits? Data pollution?
That is the billion-dollar question. You never know what the new asbestos is until it's too late.
It just makes you wonder what invisible risks we're underwriting right now.
That's a provocative thought, and honestly, that's why insurance is so fascinating. It isn't just math, it's the history of our risks, written in a ledger.
Well, on that cheerful note about future risks, we will wrap it up. Check your own insurance policies, maybe check your stock portfolio, and we'll catch you on the next deep dive.
Thanks for listening.